Let's calculate the stock price for AT&T. So the first input into the model is market cap, which is 233.5 billion. And then the stock price is 32.77. So now we know the shares outstanding. It's just a market cap divided by the stock price. That gives you the shares outstanding, 7.1 billion. Now to calculate the intrinsic stock price, we have to estimate future free cash flows and then discount those numbers back to today's value. Now that we have the value of the entire company, we divide that number by the shares outstanding, the 7.1 billion. And that gives us the intrinsic stock price. And we're going to compare it to the actual stock price to see if it's a buy or a sell. So let's get the actual free cash flows. So we'll go back to Yahoo. We'll look in the cash flow section in the financials. We'll pull free cash flow. And that's the cash that's remaining after operating your business for a year. So if there's positive free cash flow, that means they're adding value to their investors. They're increasing their cash balance. If this was a negative number, that means they would have to borrow money to just operate their own business, which does happen quite a bit. Net income is next, and that's on the income statement. That's a profit and loss for a given time frame. And then last is revenue, which is also on the income statement. That's just the sales for each year. So all the numbers look pretty good, fairly consistent, no negatives, so it should work well in the model. Now we need to know the capital structure of AT&T because we have to figure out what discount rate to apply to those cash flows. So the interest expense, the interest they pay on their debt is $8 billion. And let's see how much debt they have. We'll go to the balance sheet for that. Current debt, $11 billion. Long-term debt, $149 billion. So they have $160 billion of debt, and they pay 5.23% interest. So even though they are a big company, that's 41% of their capital structure, but it's still a big nut to crack each month, $8 billion just in the interest alone on their debt. So let's see their income before taxes, because interest payments on debt are tax deductible. So let's find out their effective tax rate. So their income is $18.5 billion. And let's see how much income tax they pay, $3.5 billion. So their effective tax rate is 19%. So the cost of the debt is 4.2%. Now we need to figure out the cost of equity. And the beta will help us with that. That's the volatility of the stock. And as I suspected, it's a pretty low beta, 0.58. It means it moves about half what the market moves. So you want a low volatile stock because it's much more secure. To calculate the cost of equity, we used a capital asset pricing model. And the lower the beta, the lower that calculation is. So the weighted average cost of capital is a blend of cost of equity and cost of debt. And that comes out to 5.74%. So that's what we're going to discount the future cash flows by. So we estimated the future cash flows based on the inputs we put in earlier for 4 years. We did a terminal value, which is all years after year 4. Then we discounted those amounts back to today's value. And we come up with a value of $506 billion for the company. And you divide that by 7 billion shares. That comes out to an intrinsic stock price of $71. So it's trading at a 54% discount. So it's considered a buy. It's trading at half of what it's worth. Now let's look at this historical stock price. So AT&T is a fairly steady stock price. It's been around in the 30s or low 40s for many years. So it doesn't move too much. The model is indicating it's a buy, but the market is not indicating that. The market is saying we think the price is $33 because what people are willing to pay is what the price is. It's not what it's worth. So let's look at their ratios. We'll get some more color in AT&T. We have to go back to the balance sheet. I need their current assets. And current assets are assets that can be converted to cash within 12 months. So they have $55 billion of current assets. And current liabilities, $68 billion, and equity of 184 billion. Now, let's look at the first ratio, the PE ratio. That's probably the most common ratio you'll see. And that's the price of the stock over the earnings per share. And earnings per share is net income over shares outstanding. Lower the better for PE. That's generally what we think. I like to invest in companies with a PE under 15. This is 17 PE, so that's not bad. That's doable, especially if the other ratios look okay. What investors are pretty much doing is they're paying $17 for every dollar of profit. And companies can lower their PE by buying back stock. Because when you buy back stock, it lowers the shares outstanding, which inflates the PE ratio and other ratios. That's why a lot of companies were buying back stock for the past 10 or 20 years. So there's a lot of ways for companies to manipulate these ratios. Of course, most things are done in the short term, because in the long term it could hurt you. But in the short term, they could definitely maneuver these things. Price to sales ratio, I like to see under 2.2, and this has a really good price to sales ratio of 1.3. It's the stock price over the sales per share. And with share buybacks also, you can lower this number too. And there's other ways to also lower the number if the company wanted to. But it's at a good number right now. So generally, if it's a low number, it's an undervalued stock. So some people might look at this and go, wow, it's an undervalued stock, I'm buying it. But if they were in a discounted cash flow model, that would prove to them it is undervalued. Because I think that's a better indicator, the DCF, than ratios. But this just gives us more comfort. Now, the price to book is the stock price over the book value per share. And book value is the equity over the shares outstanding. And remember, equity is just total assets minus total liabilities. It's the value of the company according to the balance sheet. So if this was under 1, it's considered a steal, like a really valuable stock. But you have to always realize sometimes the balance sheet does not provide the best data. So you have to actually look at the assets on the balance sheet to make sure they're good assets, because sometimes assets can be a little inflated or the quality of the assets aren't so great. To keep it simple, if it's a 1.3, that's usually pretty good. Current ratio is your current assets over current liabilities. So current assets, like I said, they're assets that you can convert to cash within 12 months. So it's pretty much cash, accounts receivables, that's what people owe you, and inventory. In AT&T's case, maybe phones would be in the inventory. So, and the current liabilities are what you owe within 12 months. So the bondholders, what you owe bondholders, and what you owe your suppliers, those are most common. And if it's under 1, that indicates they don't have enough assets to cover their short-term liabilities. So what happens? They get more debt, and they keep getting more debt to fund their normal operation. That's not a good sign if it's under 1. ROE, I generally want to see ROE above 20%. They have an 8% ROE, so they're not very efficient with the use of their equity capital. And it's always good to compare these to similar companies. I did DCF analysis on Verizon, so I have their numbers that we can compare it to. So I have AT&T and Verizon, and then I have the winner. So PE, the winner is Verizon. They have a 12 PE to AT&T's 17 PE, but they're both pretty good PEs. AT&T wins in the price to sales ratio. They're at 1.3 versus 1.8. AT&T is a clear winner in the price to book ratio because they're 1.3 and Verizon's 3.8. But like I said, you have to look at the actual balance sheet to really understand it. Don't just rely on numbers. Current ratio, ironically, they're both exactly at 0.8. So both businesses can't even fund their annual operations every year with the money that comes in from running their business. They have to keep taking on more debt. That is a big red flag if that lasts a long time. Verizon wins because I guess rounding, if we brought the decimals out, Verizon is a little better with their current ratio, but they're still both pretty weak. Return on equity, Verizon a clear winner. They are using their equity funds very efficiently. They're providing their investors a 31% ROE. AT&T is providing an 8% ROE. Why take the risk in investing in AT&T if you're only getting 8% return? I'm not saying invest in Verizon, but maybe take another company with similar risk that's providing a better return. Debt, Verizon wins in debt because they have 32% of the capital structure is debt. AT&T is 41%, but both are going deeper and deeper into debt because they both have under a 1 current ratio. So according to the DCF, it's a clear buy stock, but according to the ratios, it's not. That's why the market is not buying the stock to the point where they drove the price up to intrinsic value, $70. They just don't feel comfortable. They feel comfortable paying $32 right now. I think we provided a lot of color. Let me know what you think in the comments, and thanks for watching.